Me corté el pelo y se ve muy bien. Coupe cheveux. Li bon. All right, just kidding. It's Mr. Fit to Flourish. Let's get right into this video. We're talking about how to choose the best options today. A lot of people ask me, hey, how do you choose options? What options are you choosing? Well, I'm about to show you right now. So for this example, we're going to be looking at SPY on the 5-minute time frame. So right here, we have a nice push to the upside. As you can see, we're pushing to the upside after a major sell-off. We have a micro double bottom. I talk about this in my other videos, so check them out. But the setup here is a crossover of VWAP. So we push up with this nice bullish bar where this arrow is pointing to, this bullish bar right here. You would enter one tick above the close of that bullish bar. So let's just pretend, for instance, let's just pretend this is going to go to infinity. All right, we're just pretending that this is a call and we're going to go to infinity. So how would I choose a call option for this? And today is 6/6/2024. All right. So what I'm going to do is I'm going to go to Robinhood. Oh, actually, we have to pretend it's 6/7. So we're going to go to Robinhood. And what I usually do is I'll pick the next day's expiration. So I would go, so if today's 6/7, okay, if today's 6/7, we're going to look at 6/10, which is the next day's expiration. Okay, so I go 1 day out if I'm day trading, 1 day out. Okay, I go 1 day out. The share price is currently 535. So what I'm going to do is I know I need to understand how much SPY moves. SPY typically moves anywhere from $2 to $3 after a good push to the upside. So if we're trading at 535, I'm going to get out of the money strike prices. So that's going to be most likely 538. So I'm going to look, if we're 535, 2 to 3 strikes out would be 537 or 538. 538 is cheaper, so I'm going to click on that. It's $80. So 80 cents, you do the option multiplier of 100, $80. And what I'm looking for, I'm going to show you real quick. This stock is $80. It has a low implied volatility. So you want the implied volatility to be less than 50%. Okay, less than 50%. The next thing you want to look at is delta. The only two things you're going to look at ever on options is delta and really IV or theta. Theta, if you're swinging, but on day trades, doesn't matter. So delta is 27, basically 26.7, which is 27. So that's telling you how much your options contract is going to increase for every dollar that the stock goes up. So if SPY goes from, right now we're looking at this and the share price is 535. So if it goes from 535 to 536, then this option is going to go from $80 to $106. Okay, so right now the contract is $80, and since delta is $26, that's basically over 25%, an over 25% gain on a $1 move. So that's what I'm looking for. I'm looking for something with an intrinsic value, with a delta with an intrinsic value of 25% or more. So that's the best way to choose out of the money option, or to choose options. Get something out of the money, look at the relationship between the contract price and the delta. And if it's over 20%, then like if delta is over 20% of the value of the contract, then you're going to get an automatic 20% gain for a $1 move in the stock. This is significant. So let's say you put in $5,000 into calls, and then SPY goes from 535 to 536. Well, you just made $1,000 off of a $1 move in a stock. And people don't understand this with options. It's critical. This is insane. This is true leverage. This is how you really leverage money. And what is leverage? Leverage is little in to get a lot out of a system. And that's what options are used for leverage. Okay. And to see that same $1,000 gain on SPY for a $1 move, you would have to buy over $500,000 worth of SPY. Like, that's ridiculous. So that's why we trade options. So this is a pretty good example of, okay, what am I doing here? So let's say we wanted to get puts. Let's look at puts, because people ask me, hey, how do you choose your puts too? It's literally the same thing. So let's go back to this tab. So let's say that we get a good crossover to the downside here on SPY. and we decide to go short right here. This is a pretty good cross below VWAP. We're moving to the downside. So let's say SPY is currently at 534.51 and we're looking to go short. So now I'm buying puts. So again, I'm going to go 1 day out. So today is 6/7, so I'm going to go to 6/10. Okay. And I'm going to go 1 day out and I'm going to day trade this. So I'm going to be looking for, again, 2 to 3 strikes out. Sometimes I might go 4 strikes out though. So we're at 534. 533 would be the next, 532, and then 531. 531 is pretty cheap, so I like to get like hundreds of contracts. So $89, if I get 100 contracts, that's $8,900. So that's pretty good. So I'm looking at that. You don't have to get that much, by the way. That might be a lot to people. That might be a little bit to some people. It doesn't matter. But the concept here is the contract price is $89. And now, what did I say? You want a delta that is about 20% of the contract price. Because if you move $1 to the downside here in terms of puts, then we get a 20% gain automatically. So delta is 25, basically 24.9. And it's negative because you're buying puts. Okay, so it's basically telling you the stock's going to be going down. That's good. So delta is 24.9. So that's over 20% of $89. Okay. So that relationship is what we're looking for when we are looking to get options. We're looking for the delta to contract price ratio. That's the most important thing when you're day trading. Delta to option contract price. That's going to tell you how much money you're going to be making for every dollar move. Okay. And then if you're going to be swinging options, then it's a little bit different. So let's take a look at what if I wanted to swing, SPY. So let's share the screen one more time. So that would be a little bit different. So if I'm going to be swinging, I need to know how long do I think it's going to take for the move to be made. So for instance, let's get here on the daily time frame. So we're going to go to the daily time frame. I have a lot of notes here about what's going to happen. I shared it with a lot of people on TikTok and people in my trading group. But let's delete all that stuff. And let's take a look at this. So it looks like this is pretty bullish. SPY is pretty bullish here. We have a nice slingshot doji. It's an outside bar. We're pushing to the upside. We have a ton of buyers here, it looks like, depicted by these bottom side wicks. We're above the 20 MA on the daily time frame right now, pushing up into this call zone. If you know about ATRs, we're pushing up. We're at 534. So where do I think we're going to go and how long do I think it's going to take to get there? That's how you're going to choose your option. So right now, based on this, it looks like SPY is probably going to go to 540-ish because how bullish it is. We're creating all-time highs. Looks like we're going to get to 540. Okay. Looks like we're going to get there. Now, how long do I think it's going to take to get to 540? Well, based on SPY's daily movement, it looks like today or the day before today, we went from 530 to 534. That's $4 to move. Here we went from 526 to 528. That's to 528.61, about a $3 move. This move here was 523 to 520. So it looks like on average, it's making these like $4 moves when it pushes to the upside. So I think that it potentially will take 2 to 4 days-ish to get to about 540. So how am I going to play that in terms of options? So in terms of options, I think we're going to get to 540. So I'm going to choose 540 because I think we'll get at least to there, but I think we can go way past it. I think we can get to like 545, 546. So when I'm choosing calls, which is what I'm going to choose because I think we're going up. When I'm choosing calls, all that I need to know is the direction I think the stock is going in. So I think it's going to go up, so I'm getting calls. Now, I can choose a pretty far out strike, but I don't want to be too far out where I'm not making any money. I want to look at my contract price to delta ratio. So if I think it's going to take 2 to 3 days, I'll usually do 2 to 3 weeks out. So today is 6/7, so 6/14, 6/21. So you could do 6/14 or 6/21. I'm probably going to choose the 6/21. I'm going to be buying calls here. So currently we're trading at 535. So if we're at 535, I'm going to go about maybe 4 to 5 strike prices out if it's a swing trade, because I think that we're going to be going to 540, like I said, right? So I'm going to click on the 540 because it's pretty cheap, $261. I wouldn't want to get these because they're a little bit expensive, $400. Yeah, I'm not picking that. So $260 is really good. The volume is good. That's one thing I forgot to mention is you want volume to be at least 500. 14,000 for the volume is really good. So the volume is 14,000. Our delta is 35. And for a swing trade, that's really good because we're going to expect a $5 move. So if delta is 35 and we're getting a $5 move, so for every dollar that we go up, delta, the contract goes up $35. So 5 times 35, we're going to be close to $170 up from $260. So that's almost a 100% gain. That's insane. And so that's what I'm looking at. I'm looking at implied volatility, again, less than 50%. That's good. Volume, really high. That's good. And then data tells you how much you'll lose on your contract every day that you hold it. So as long as the stock is moving up, then data can get kind of knocked out by delta. Delta will cause our contract price to keep going up. But if the stock price is not moving, then we're going to start losing money on our contracts. But again, the expiration date that I'm choosing here is June 21st. So it's about 2 weeks out. So 2 weeks out if I'm going to be holding it for about 2 to 3 to maybe 4 days maximum. That's how I choose my options. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and